Right now, somewhere in the UK pension system, there is money with your name on it. Not eventually, not in theory, right now. And the overwhelming chance is that you have not touched it yet. We are talking about over £1,000 a year. For some people, significantly more. And it is not hidden in some complicated loophole or obscure scheme. It is sitting in plain sight in a system that was specifically designed to support you, funded by contributions you already made, waiting for you to simply reach out and take it. Most people never do, not because they are careless, not because they do not need it, but because nobody sat them down and explained it clearly until now. Stay with me for the next 15 minutes, because by the time we are done, you will know exactly where this money comes from, exactly whether you qualify, and exactly what you need to do today to make sure you do not leave it behind for another year. Let us start with the number that matters most, and let us be honest about what it actually is. When we talk about £1,200 a year, we are not talking about a single check-in arriving in a single envelope. That is not how this works. And honestly, that is part of why so many people miss it. The £1,200 is the combined annual value of a set of entitlements that work together. They interact with each other, they stack. And when you claim them in the right way, in the right order, the total annual increase to your household income reaches £1,200 or more. For some people, it is much higher. If you rent your home, if you have a disability, if you have caring responsibilities, the figure can be $2,000, $3,000, or even more per year. But we are going to focus on the 1,200 core figure today, because that is the number that applies to the widest group of people watching this right now. So where does it come from? Let us break it down piece by piece. The first and biggest piece is something called pension credit. And before you switch off because you have heard those two words before, I need you to stay with me, because I promise you the reality of pension credit is almost certainly not what you think it is. The government's own figures show that approximately £1.7 billion worth of pension credit goes unclaimed every single year in the United Kingdom. Not some years. Every year. Billion with a B. That works out to around 800,000 eligible households across the country who are not claiming money they are legally entitled to receive. 800,000 households. And if you are watching this right now, there is a real statistical probability that you are one of them. The average amount those households are missing is around £1,300 a year, just from the guarantee credit element alone. Now, the most common reason people do not claim pension credit is a false belief about eligibility. Specifically, people assume they earn too much. They have a small private pension. They own their home. They have some savings. And they think that rules me out. It does not. Not automatically. Not in the way most people assume. So let us be very clear about who actually qualifies. You need to have reached state pension age, which is currently 66. You need to live in England, Scotland, or Wales. And your weekly income needs to fall below certain thresholds. For a single person, the guarantee credit element kicks in if your total weekly income from all sources, state pension, private pension, any other regular payments, falls below approximately £218 per week. For a couple, the threshold is around £332 per week. If your income is below those figures, pension credit will top you up to that level. The difference between what you currently receive and that threshold figure is paid to you directly, every week for as long as you remain eligible. But here is where it gets interesting, and here is the piece that catches people out. Even if your income is above those thresholds, even if you are comfortably above them, you may still qualify. There is a second element of pension credit called savings credit, which applies specifically to people who reached state pension age before April 2016. This element exists to reward people who made some provision for their own retirement, and it can put money in your pocket even when your income is above the headline guarantee credit threshold. Beyond that, there are additional elements of pension credit that can be added if you have caring responsibilities, if you have a disability, if you have certain housing costs. Each of these elements is calculated separately. Each can add to your total entitlement. Pension credit is not a simple yes or no. It has layers, and the only way to genuinely know whether you qualify is to actually check, not to assume, not to guess based on a headline figure you half remembered from a conversation 3 years ago. Now let us talk about why the pension credit gateway matters so much. Because claiming pension credit is not just about the pension credit payment itself. it is about what it unlocks. When pension credit is in payment, even a small amount, even just a few pounds per week, it acts as a key that opens a series of other entitlements automatically. The first is council tax reduction. In most local authority areas across England, Scotland, and Wales, pension credit recipients are entitled to a full reduction of their council tax bill, not a partial reduction, full. The average annual council tax bill in England in 2026 is over £2,000 for a Band D property. If pension credit wipes out that bill entirely, that is £2,000 a year that stays in your pocket. For many people, this single benefit alone exceeds the headline £1,200 figure we have been talking about, and it flows automatically once pension credit is claimed. The second thing the gateway unlocks is the warm home discount. This is a payment of £150 applied directly as a credit to your energy bill each winter. For pension credit recipients, it is triggered automatically in most energy supplier schemes. You do not apply separately. You do not have to remember to ask for it. It happens because pension credit is in payment. In an environment where energy bills remain a serious burden for older people living on fixed incomes, £150 is roughly 3 to 4 weeks of heating costs. That matters. The third thing the gateway unlocks is housing benefit for those who rent their home. If you are a pension credit recipient and you rent privately through a housing association or from a local council, you may be entitled to housing benefit that covers a significant portion of your rent. Depending on where you live, your household size, and local housing allowance rates, this can run to several £100s per month. For renters, this is the largest single component of the overall picture, and it is the component that can push the total annual benefit well above the £1,200 headline figure. So when we say £1,200, understand that is the floor, not the ceiling. For many people, the full value of what they are missing is considerably higher. Before we go any further, I want to address something directly, because I know it is sitting in the back of the minds of many people watching this. There is a generation in this country that was raised with a very clear message about self-sufficiency, about standing on your own 2 feet, about not taking what you have not earned. And for a lot of people who fall into the eligible category for pension credit, that message runs deep enough to stop them from claiming something they are absolutely entitled to. I want to be very direct about this. Pension credit is not charity. It is not a handout. It is not something designed for other people. Pension credit is funded by the national insurance contributions that you and your employers, on your behalf, paid into the system throughout your entire working life. Decades of contributions. Contributions you made when you were working, when you were raising a family, when you were doing everything you were supposed to do. The entire point of the national insurance system, the entire bargain that your generation entered into when you first started paying in, was that you would contribute when you were working, and the system would be there for you when you needed it. Claiming pension credit is not a moral failing. It is the system working exactly as it was designed to work. And here is the part that matters most. If you do not claim it, the money does not go to someone who needs it more. It does not help anyone else. It simply disappears back into government accounts and gets spent on something entirely unrelated to you or your welfare. So if the stigma around claiming has been holding you back, I am asking you to set it aside. Not permanently, just long enough to check whether you qualify. Because an informed decision to not claim is completely different from an uninformed assumption that you do not qualify. And right now, 800,000 eligible households are making that uninformed assumption every single day. Let me introduce you to 2 people. Their names are not real, but their situations are. Because between them, they represent millions of people across the UK who are in exactly this position right now. The first is a 68-year-old woman living alone in a terraced house in the Midlands. Let us call her Jean. Jean receives a state pension slightly below the full amount, around £210 per week, because she has some gaps in her national insurance record from years she spent working part-time while raising her children. She also has a small private pension from a previous employer worth about £80 per week. Her total weekly income is around £290. Jean has never claimed pension credit. She assumed, reasonably but wrongly, that her private pension put her above the threshold. Jean is wrong. Her income of £290 a week is above the basic guarantee credit threshold. but she reached state pension age before April 2016, so she qualifies for the savings credit element. She also qualifies for an additional disability element because she has a long-term health condition. When her full entitlement is properly assessed, Jean is entitled to a pension credit payment that, combined with the council tax reduction it unlocks and the warm home discount, is worth over £1,400 per year. She has been leaving that money behind for 3 years. The total she has missed out on approaches £4,200. Jean is not an unusual case. Jean is a common case. The people who fall just above the headline guarantee credit threshold without realizing other elements might still entitle them to something are among the most persistently underserved group in the entire pension landscape. Now meet Robert. Robert is 63 years old and 3 years away from state pension age. He spent 15 years working in the UK, then 12 years working abroad, then returned and has been working here for the past 8 years. His national insurance record shows 23 qualifying years. He needs 35 for the full new state pension. His current forecast puts him at around £148 per week at retirement. Significantly below the full rate of over £230, Robert can fill some of his gaps. Not all of them. Some years fall outside the allowable window, but he can fill enough to add £50 to £60 per week to his state pension, roughly £2,800 to £3,100 per year for the rest of his life. If Robert lives to 85, which is a reasonable expectation, the total financial impact of the action he takes in the next few months could exceed £60,000. Robert does not know any of this. He has never checked his national insurance record in detail. He has a vague sense that his pension might be lower than average, but no real understanding of why or what he can do about it. That ends today. Let us talk about the national insurance piece in more detail because it is completely separate from pension credit, it applies to a different group of people, and the time window for acting is genuinely narrowing. Every qualifying year of national insurance contributions adds approximately £6.58 per week to your state pension. That is roughly £342 per year. If you are missing 3 years from your record and you can fill those gaps through voluntary contributions, you are adding over £1,000 per year to your pension income for the rest of your life. The cost of filling those 3 years at the current rate of around £824 per year is approximately £2,472 in total. Your break-even point is less than 2.5 years of retirement. Everything after that is money that compounds in your favor every single year you are alive. Now, the window for filling historical gaps is not permanent. The rules around how far back you can go and the rates at which you can purchase missing years are subject to change. With each passing month, the window of action narrows. And we are in March 2026, which means people who have been meaning to check their national insurance record, who have a vague awareness that they might have gaps but have not yet acted on it, are genuinely running out of runway. This is not manufactured urgency designed to make you feel panicked. This is real urgency grounded in real deadlines and real financial consequences. The kind of urgency that if you let it pass without acting, you will not be able to go back and undo. So what do you actually do? Let us get into the practical actions, the actual specific steps you can take today, not next week, today. The first thing to do is check your pension credit eligibility. Go to gov.uk and use the pension credit calculator. It takes about 10 minutes. You will need to know your weekly income from all sources, your state pension amount, any private pension payments, any other regular income, and your housing costs if you rent. The calculator will give you an immediate indication of whether you fall within the eligibility range. It is not a perfect assessment, and it does not replace a proper claim, but it will tell you quickly whether you are in the ballpark. If the result suggests you might qualify, the next step is to call the pension credit claim line. The number is 0800-99-1234. This is a free call. The advisors on this line are trained specifically to assess your eligibility, and if you qualify, they can take your claim over the phone in a single call. You do not need to fill in a form beforehand. You do not need to visit any office. You can do this today from your home in a single phone call. Here is something important to know about backdating. A pension credit claim can be backdated by up to 3 months in most cases. That means even if you have been eligible for several months and are only finding out now, you will not necessarily lose all of that backdated entitlement. Those 3 months of missed payments can still be recovered. The third action, and this one is specifically for anyone below state pension age who has not checked their national insurance record recently. Go to gov.uk, log into your government gateway account, and look at your state pension forecast. If you do not have a government gateway account, create one. It is free and it takes about 15 minutes. Look at how many qualifying years you have, whether there are any gaps in your record, and which of those gaps fall within the window where they can be filled. The fourth action, if your national insurance record does show gaps. Before you make any voluntary contribution payments, call the Future Pension Center on 0800-731-0075. They will tell you precisely how much each additional qualifying year will increase your state pension at your specific retirement date. That information is essential before you commit any money, because not every gap year is worth filling, and not every gap can be filled, and an advisor will tell you which ones to prioritize. The fifth action is the one that applies to people whose situations feel complicated. If your history involves overseas work, periods of self-employment, time spent on carrying credits, contracting out, or anything else that makes your situation feel non-standard, get specialist help before you make any decisions. Age UK's national advice line is 0800 678 1602. It is completely free. Citizens Advice can be reached at 0800 144 8444, also free. These organizations have specialist advisors who do nothing but this every single day. They will not judge you. They will not rush you. They will not charge you anything. And they will make sure you are not making decisions based on incomplete information. Let us bring this together with a clear picture of what we have covered today. There is a benefit called pension credit that 800,000 eligible households across the UK are currently not claiming. The average annual value to those households is approximately £1,900 in pension credit alone. When you factor in the council tax reduction it unlocks, the warm home discount it triggers, and the potential housing benefit it opens for renters, the total annual value for many people is well above the £1,200 headline figure we started with. There is a separate opportunity for people below state pension age who have gaps in their national insurance record. Filling those gaps through voluntary contributions can add hundreds of pounds per year to your state pension income for the rest of your life, and the window for acting is genuinely time limited. Both of these things are real. Both are available. Both are accessible today, with free phone calls and free online tools that exist specifically to help you navigate them. The only thing standing between where you are right now and claiming what you are legally entitled to is taking the first step, checking the calculator, making the call, logging into the government gateway for the first time. 15 minutes of action today could put over £1,000 a year into your household income for the rest of your life. That is not a small thing. That is a significant, meaningful, life-changing amount of money, and it is yours. Please do not leave it behind. If this has been useful to you, share it. Send it to a parent, post it in your family group, forward it to a friend who you know is managing carefully on a fixed income. One share from you today could be worth over £1,000 a year to someone you care about. And if you have questions, anything about your specific situation, anything we did not cover today, leave a comment below. Every question gets read, as many as possible get answered, because that is what this community is for. The money is real. The eligibility is real. The only question left is what you do next.